Hello there, everyone. This is your December real estate market update for the Vancouver area, the overall area. So, yes, the toughest market in 43 years. Now, what's happening next? Today, we're going to cover three big things. Number one, what has the real estate market done in 2025? And number two, what is going to make the market go back up now? And number three, what will make the market go down even more? All three are in this report, so let's get started. First of all, let's have a look at what the market's done in 2025, okay? This year, prices for low-end homes have dropped about 30% from the peak, and that makes this the slowest market in 43 years. You guys, the numbers are terrible. Let's have a look at the numbers now. So as we start in Vancouver, we had 6,577 listings in the month of October, and we had 602 sales. We'll be redoing November real fast, but that's a 9% sell-through rate. Ladies, gentlemen, I need at least 10%, if 15%, to be stable. So this continues to push the prices down. Now, in the Fraser Valley, we also had almost 6,000 listings and 500 sales. Once again, 9%. So this is not stable. The market continues to have pressure. Now, if you've never discovered the Vancouver market reports, we're sitting here with a little over 17 million views and about 1.7 million subscribers. So do find this, and this is your Bible to the industry. Now, what we publish every 2 weeks is the number of sales for the previous 2 weeks. So on November the 14th, boy, please don't let me break your eyes here, folks. This is a lot of data. I've been doing this for 43 years. I designed the original home price index. I am a data man, so we're over 4,000 or 5,000 hours of study here, and I apologize for all the numbers, but real simple. For the November the 14th, we had 5,400 listings in the Fraser Valley. We had 224 sales. That's an 8.9% sell-through rate. Not good. And you can see some cities here like West Surrey, with 795 residential detached homes for sale, only 20 sold at the monthly for the time. And at the monthly rate, that is a 5% sell-through rate. So what that means is 95% of all the homes for sale in West Surrey are not selling this month, a 95% failure rate. Now, as we skip over into Vancouver, here, we're sitting with a total of 6.8% of the homes are selling. That's 189 sales in 2 weeks with 6,000 listings. Oh my gosh, that is record low. Okay, so some of the bad ones here: Burnaby, with almost 500 homes for sale, only sold 6 homes. Now, by the way, how the money works is when we sell homes in Richmond or Vancouver or Burnaby, they move out towards Coquitlam, or they move all the way out to, say, Maple Ridge or Surrey or Langley or Abbotsford, Mission, Chilliwack. So we've seen money move 11 times in total. The last one ends up in Horsefly, or up by Williams Lake, right? But bottom line is the sales starts here and moves out as people downsize. So listen, if you ever discover this stuff, there is more information than you can believe to help you understand the future. This gives you the actual glimpse into which ones. The only one doing well here is North Vancouver at 17% sell-through rate. They could actually raise up 5-10 grand this month at that rate. So look at 17% of their homes are selling, and everybody else is doing just terrible. So that's the reality picture. Let's have a look at the big graph. So this, I chose the city of Abbotsford, and I chose the lower 50%. So if you discover Vancouver market reports and you discover the evaluator, it splits all the markets into high end, the people that are typically cash, $2 million, $3 million sales, and the lower end, which are your first time buyers borrowing their down payment from grandma, right? And need a mortgage and need a job. So this in particular case, I chose the lower part of Mission, and from July of 2022, the prices increased $624,000. They virtually doubled to $1,347,000. So it was going up at a rate of $31,000 a month for this 20 months. And then in the after Russia invaded Ukraine, right at the peak here, it then dropped to 932,000, and it was dropping here at $51,000 a month for that period. And then we had a little bit of recovery in the spring, and a little bit of recovery in the spring, and barely a very little recovery this spring, and then we've had pressure on ever since. Okay, so today's values from that $1.347 million, we're now down on average in Abbotsford for our lower end homes at $946,000. Okay, now that is a 30% drop. Now, if we're having a look at, there's the condition we're in today. Okay, so now let's look at the forward motion here. What happens if we have some positive news and prices start to recover? So let's say from today's current 946,000, we go up 5%. Over the next year, we hit $1 million more or less. Okay, that could happen under these positive forecast conditions. They need to drop the interest rates. 1% in a month would bring the buyers back fast. They need to perhaps remove the stress test. 2% extra stress test on their mortgage application blocks thousands of buyers. They need to restore the 35-year amortization we did during the 2008 crash. And we've got a total ban on foreign capital coming into our country, so we need to let some of it back in, controlled. We don't need $2 trillion from mainland China or India to totally skyrocket our values, but we could use some to stabilize the crash, right? And a really good suggestion for new homes right now, our new housing industry is virtually crashed to the ground. I'm hearing out there that 75% of our builders, our trades, our drywallers, our plumbers, our framers have no work this week. So residential homes, you cannot finance the build, and we're not getting the sales. It is just absolutely closed down industry. And to explain that, in our economy, and as in many economies, real estate, construction of homes is like 1/3 of the entire gross national product. It is what makes money go around. So picture this: if we build a brand new home today, it's going to create 20 man-years worth of work. So what am I talking about? The guy that plants the tree, the guy that cuts the tree, the guy that drives the logging truck, the sawmill, the framer, the plumber, the drywaller, all of those trades add up to 20 man-years worth of work. So when we do 1,000 new homes this year, that's 20,000 full-time jobs just for our lower mainland. So they're trying to build 2 to 400. They need 400,000 jobs or houses in Canada, so call that for a round number. That's going to be 800,000 jobs that are missing today because construction has crashed to the ground. Now, if we restore the 35-year amortization, this lowers the payments by 8%. More people qualify. We've got more buyers. Now, here's a suggestion for the building industry. Why not completely cancel GST on all new homes? And why not cancel PST for a break, say 3 months? If you buy a new home, the builder is not paying GST on any of that product, and neither is the buyer. And if you're buying any home, there's no PST either. Those would really help stimulate the market. Now, the big one is getting the banks to lend again, and they are scared. Let me show you how that works. So, when prices went up, for example, we're in the city of Abbotsford here, to 1.3 million on average, and then they start to fall. Well, the bank is insured through CMHC. That's us, the taxpayers, and give them insurance. We give them an insurance so that they're protected. So if the market falls right down to 1,070,000 and they go bankrupt, we're insuring the mortgage for them. So that's good. But the market's fallen more than that. So as the market comes down to here today, right about here, the banks get any mortgage with 80% mortgage, 20% down. They're getting insurance to say they'll never lose money. We, the taxpayers, pay that. But when it drops below that, the bank is 100% responsible. So if the market does drop another 15%, we're down 30 right now, but if it drops another 15, that means all of these buyers here are now underwater. And if they get foreclosed on, that bank is going to lose money. Actually, it's less than that. The more we drop, it'll be like this. So pretty much we've got 3, almost 4 years of buyers here that are in jeopardy of having less equity than their house is worth. Now, when they go to get refinanced, they're not getting refinanced. The appraisal comes in so low, they've got no equity left. And the banks are not going to. Now, for some of these people back in the COVID time, mortgages went right down to 1.39% for a 5-year fixed. Well, those mortgages are now due. And now we're talking more like, we'll say 4.25%. Clients are telling me their mortgages have gone up 3 times, 300% increase, and they can't qualify at the bank anymore. Their equity, well, here their equity would be fine, but anybody in this top end here, their equity has got diminished to the point that they have nothing left. If they walk away from the home, there's no money left. So the banks are scared silly to lend anybody money unless you got at least 20% down, and even at 50% down, they're still nervous as Nellies. They've stopped financing new homes really for the last 4 years. The banks have stopped financing all of this time. They just won't let anybody build a new home in general. So that's what the banks need to do. They need to. So we need to get the banks to lend again. They need to open the vault, more approvals, more sales. Right now, when somebody makes an offer on our homes, we feel that we've got close to a 60% failure rate at the bank approval. The banks are so nervous of losing money and they're not insured below the 80%. So, okay, moving on. How do we get money into the country? We need to give tax breaks on the foreign investments. For example, if you do a development here in Canada, and just for a real quick number, your capital gains would be roughly 62%. And then, so that leaves you, say, $1 million. That gives you, that's 380,000 left over. And then when you pull the money out of your corporation to personal, it's another 52. So 380, call it 50. That's 190,000 left over. And then, of course, when you buy anything, you accumulate all the taxes, the GST and the PST and everything. You got a huge cost there too. So if you move your money to the States, you can sell your $1 million profit and roll it into another investment with the 1030 exchange with zero tax. Zero tax. You're not get left with 190,000, you're left with $1 million. Okay? So we have seen a huge exodus of our money leaving the country. So when Carney was talking to Trump, he says, we've already given you $500 billion of investment into the States, and we promise $1 more trillion. Well, no. We need the investments here in Canada. So how do we get these foreign investments to actually spend money in development in Canada? We need to give them some tax breaks. Okay? Incentives. Now, if all of these things happen, or even a few of them, if 3 or 4 of these things actually happen, drop the rates, remove the stress test, restore 35-year amortization, allow some foreign capital to come in, remove the GST on new homes, get banks to lend again. Like the last time in 2008 when the market dropped a lot, we went from, this is what we did for our 5-year mortgages over the last 4 substantial drops. I actually started in the early 80s here, 82. I started real estate, and my wife and I tried to get a home at 22% mortgage, and we finally bought one the next year at 12%. So look, they dropped the mortgage rate by 83% when that market crashed. It dropped 69% in about 18 months. Now here, in the 2008 crash, we had our interest rates at 5.1 on January 31st, and by April 30th, within 2 months, we dropped it 44%. Within 3 months, we dropped the interest rate 44%. Okay, so big drop. And then in 2019, market was a little bit tough there, so then we had COVID starting to kick up. We had already dropped rates pretty good. And at the end of the day, we ended up dropping 133% in 22 months. From January 31st of 2019 to November the 30th of 2020. Okay? And even the second little bump in a year, in 11 months, we dropped at 79%. So what have we done today? Well, from September of 2 years ago till today, we've dropped it 44%. That's over 1 year. 2 years. What am I talking about? That's actually 2 years. My mistake. 2 years. Okay, so yes, that's why is the government so hard on not dropping rates like they did here? They did here. And guess who was in charge of our bank here in this period when we had our 2008 crash? It was Mark Carney was our governor of the Bank of Canada. So he authorized a 44% drop in 3 single months, not in 2 years. So why would he not stimulate the economy today? Well, here once again, here's the challenge. If the banks are in jeopardy right now, so well, actually, so here's a conspiracy theory for you. Prices have gone way up. So they say in the Vancouver market, 80% of the people here can no longer afford to buy a home. So both the federal government and the provincial government ran on platforms to make things more affordable. So how do they do that? Sure, they can build some government housing perhaps, but that's not going to do it. But what they can do is keep the interest rates high, keep the pressure on the market. And look at this, it's dropped from 1.3 million down to 787,000 by this time next year. They have achieved their election promise. They have made houses virtually drop by 80% and more affordable. So does the government really want to turn the market around? I don't know if they do, folks. I think to keep their election promise, they really do want to push the market down. So now let's talk about what it takes to make the market actually drop more. We've talked about it going up. These conditions will bring it up, say 5%. Does the government actually want that? I don't know, not sure. But let's talk about what it takes to bring it down more. Okay, if they're going to do interest rate cuts, a quarter point does not make any difference. It actually makes the buyers wait because they hear, okay, it'll go down in January. And the prediction there is like a 5% chance they'll drop rates in January. So the inflation has gone up. So when we put our 25% tax on food and a lot of stuff on the states, that creates inflation. So now we have not achieved our 2% inflation rate because we collected $2 billion worth of extra revenue from us consumers that forced the price of inflation up. So, secondly, we don't have a U.S. trade deal. We now have the highest tariffs in the entire world. If we had 35% on our non-NAFTA agreement, and supposedly it went up another 10% when Doug Ford spent the $75 million ads in the States. And by the way, that's more money than the Conservative and Liberal Party were allowed to spend for the last election. That's a lot of money on ads. And those high tariffs hit exports and they cause job losses. So we're seeing companies move to the States. Now, China has also got a horrible trade tariff, 100% on our canola, our pork farmers, our fish, our seed, 74% on our seed. And nobody's talking about it, but that is devastating for our farmers. So if we need to break these, that these cannot continue. The plant foreclosures moving to the USA, they kill jobs, and more than jobs, they kill confidence fast. So when I saw the federal government passed a budget that increases debt by, don't quote me, $78 billion, for a total of maybe $380 billion over the term, that was actually received by Canadians as a positive thing. And then I see numbers that the Liberals, if they had a new election today, would get a mandate. They'd win the entire election because people think borrowing money is a good idea. So interesting. Okay, we've talked about what's going to make the market go up, of course. Now we need to really study what will make the market go down. So in summary, one more time, the interest rates cuts can't be a quarter. And it sounds like we might not get a cut in January now. They need to drop it like Carney did in 2008. Drop it a full 1.5 points within weeks. make 44% drop in interest rates overnight. That will turn the market. We need some trade deals here. We need to actually talk to the states and make a trade deal. Like, we've got the highest in the world right now. And we also need to deal with China. 100% tariff down to 78% on the canola seed. Holy crackers, that's hurting a lot of people. We need to stop companies from moving to the States. What do we have to do to incentive them? Please don't move your manufacturing to the States. Kills jobs and it kills the confidence. When the majority of Canadians were very happy with the $78 billion deficit budget that just got passed, it sounds like that's enough confidence to win the next election with a landslide. But I don't see that confidence extended into people actually buying homes. It's in fact opposite. So the worst sell-through rate ever. So that tells me the confidence isn't that confident, okay? Now, taxpayers funding mega projects. Today, we've lost so much foreign investment. So when Carney was seeing Trump last time, he says, we've given you $500 billion of investment, Canadian money, into the States, and we're going to give you another $1 trillion. Okay, well, we could use investors investing in Canada. So when we give $1 billion worth of money for China to build ships or ferries, that means we're employing all of them and not Canadians. And then when the potash chooses to not use the Vancouver port for a $1 billion expansion, but goes south to, I believe, Vancouver, Washington, and is spending $1 billion in the States again. And then when our own capital leaves, like, we got so much capital leaving this country right now, it's crazy. In fact, let me show you what the pension plans look like. Well, actually, let me first show you what capital came in with the Chinese cash helping inflate our prices. So in the early 90s, we started to get a lot of money from Hong Kong. So that's all this purple money here and a little bit of Chinese money. But overall, this money came in and it inflated our sales from what would normally be about 1,300 sales all the way up to 4,291 sales in the year of 1994. Huge amount, $500 billion of Hong Kong money coming to Canada, Vancouver, inflating our prices a lot. Okay, and then after that we had mainland China starting, we'll call it more or less in the 2000s, but here, crazy amount of sales here in the year, in this period in 2016, we ended up with 4,400 sales for, this is the time period of January to February, over our normal, say, 1,500 Canadian sales. So all of this red here and this purple is foreign capital coming into our market. All of the blue is our own local Canadiana. So what did that do to our prices? Pushed them up 732%, the highest in the world. Okay, so that's what incoming capital does to a marketplace. It causes massive inflation. Okay. So in reference to our pension plans, oh yeah, here it is here. In 10 years, 20 years ago, 74% of all of our main pension, Canada's pension plan, the Canada Pension Plan Investment Board, which is close to $714 billion. Apparently we have about $3 trillion worth of total pension plan investment. Well, they were 74% invested in Canada. Of course, good choices like Nortel, Ballard Power, what's another good one? BlackBerry. There you go. didn't exactly work. But now today they've divested and they're down to 12% of our pension money is sitting in Canada investments. And the rest they've moved out. And apparently they're getting something like 9.6% return in this, say, South in the States, and they're getting 5% return in Canada. So one of the big pushes from the federal government is pushing hard for Canadian companies, our pension plans, to start bringing money back into Canada. But if they don't make the returns, if they're making double the returns in the States, why would they do that? So he's going to have to legislate that or something to say you're forced to invest in Canada. Possibly, right? But it's not going to happen voluntarily because everybody is responsible as a board to make sure they got the maximum profits, right? So in summary, one more time here, the banks need to loosen their lending rules. If they keep tightening their lending rules, we're getting no financing for anything. We can't get financing for development today. Nice new townhouse development available right now, and it's got over 100% return on investment, and the banks are not going to finance it. It is just virtually impossible. So how did Carney manage to fix this last time? Well, actually, back here in 2008, our interest rates, we dropped them from 5.19 to 3.59 in, 3 months, right? And in that period, the banks also went from lock the vaults. Like back in this January of 2009, the banks also were in so much fear that we would drop a further 25% that they had locked the vaults. I'm telling you folks, they used the great big titanium links in the chain and they wrapped it around the vault. Nobody's getting money out of it for nothing. And all of a sudden, overnight, they're lending money to everybody. It felt like your dog could get a mortgage, okay? But what made the change? Why would the banks move away from the fear of going insolvent because of pending foreclosures and open up the vault and lend to everybody? The conspiracy theory is they got a $56 billion slush fund given to them to cover any future losses. And that would have been part of Mark Carney's tutelage at the time. He's the governor of the Bank of Canada. Between him and our finance minister, Mike Flatterly, they pulled off a miracle and they had us return overnight. Within 2 months, we had the fastest economic return, real estate return in the Western world history. So he's got the experience to do this. Why isn't he doing it? Is his promise, election promise, to make housing more affordable? And does that really mean he needs to force prices down another 15% over the year and make homes more affordable? It's just the people that bought in the last 4 years are going to get hurt a lot. So it's your choice on understanding which is the better scenario for the positive or the negative forecast. But here we also have the high immigration. So 1.4 million people here in Canada for the temporary foreign workers program, and apparently counting the students, we're up to 2 million. So those people are not buying homes, they're renting. So that has caused a crisis in rental prices over time, right? It just absolutely doubled the cost of rentals, hurting our Canadians. And those 2 million people that are working have been taking away 2 million Canadian jobs. So our youth unemployment and don't quote me on this, but I'm hearing 24% for under, 25, 30 years old. It is devastating. They call our Canadian unemployment rate around 7%, but I don't know how they do the math there. Bottom line, it's very, very tough right now today to get a job. In fact, a story on that, when my grandson, grade 12, all of his friends could not get a job the entire summer. Every one of them that tried, they actually could not get a job anywhere. So that's really devastating for our youth, right? So there's really good talk about some natural gas exports in BC and Alberta bringing in some exports. But we have a tanker ban, and if the tanker ban stays, there's going to be no West Coast energy exports, folks. There's no relaxation on the tanker ban. And then the emissions cap, that law says we can't really develop anything because our emissions cannot go up. They have to go down. So that actually stops all development. And it still seems to be there. And then slow approvals. We've been told that we're the slowest in the world to get anything approved. Germany did their liquid natural gas plant about 2 years ago. They did it in 6 months, from start to finish, completely finished in 6 months. We take 10, 15 years to get anything going. So these slow bureaucratic strongholds, slow approvals with all the bureaucracy, the heavy environmental delays, does that take years to study, an endangered shrew somewhere? Years, stalled projects. And now the last one is the craziest government borrowing ever. If we've actually hit $1.35 trillion of total debt now, just on the federal side, that reduces our dollar. It's no longer, in my time, we've been $1.05 at one point, more than the Americans, and today we're pushing closer to 70 cents. The more we borrow, the more we dilute our dollar. So if we're down to 65 cents, 60 cents, our cost of buying anything, that inflation goes up that crazy amount. So you buy anything today from the States, it's like what, a 35-40% higher price because of our low dollar, right? So I think we're getting close to a risk of losing some of our credit ratings here. And if we do drop in our credit rating, then our debt, servicing our debt, goes up dramatically. So right now, apparently, just paying the interest on our debt, that $1.35 trillion, is all the GST you pay. So the government has to stop borrowing. They have doubled the size of the federal government and the provincial government in the last 10 years. Folks, where's the money coming to pay for these extra departments? More government is not necessarily the answer here, folks. Quick little story. If Kinder Morgan was built out by Enron, their budget was $7.4 billion for twinning the pipeline. We as taxpayers bought it, and it cost us $40 billion. So do the math, like 400% higher cost price. And typically, when we have government do something, not only is it 4 times as expensive and takes 3 times longer, often we can't find the front door. They forgot to design a front door in the building, okay? So government borrowing and government doing business is not a very good answer. That's not their skill set, okay? So I think government just needs to get out of the way and encourage the foreign investors to invest, and they're only going to do that if they can make money. And if our natural gas comes out of the ground at $3, whatever unit it's called, $3 a cubic, whatever, and they can sell it for $11, holy crackers, there's some money to be made there. And we as Canadians are getting roughly 40% of the revenue as taxes on that. That pays all of our national debt. Totally. If we allow these projects to go through. But going to have a tanker ban, that'll kill it. Going to have emissions cap, that'll kill it. Going to have 10, 15 years to get a project approved. What foreign investor is going to put money into that and take 10 to 15 years and have a high risk factor that we can't come to agreement with, say, for example, our indigenous land claims, right? So that's the negative forecast. So you decide, is much of this going to change and we continue our pressure on our market, or is much of this going to change? Are we going to have big interest drops, remove the stress test, increase amortization to 35, allow some foreign capital back into Canada, remove the GST on new homes, get bankers to lend again? If we have to give them $56 billion worth of slush money to protect them from going insolvent, we do it. And a 3-month break on PST, tax breaks on foreign investments. Don't let them make $1 million and leave town with $190,000. Guys, they're not going to go here. They're going to go south. They're going to go to other countries. And that's, in fact, what they have done in mass. Imagine that. We've lost $500 billion this year to the States. Would we not love $500 billion investment in Canada today? You know, $1 billion here and $1 billion there is not $500 billion. We need investments to make jobs. We need to sell trees, gas, coal, copper. We need to get stuff out of the dirt and sell it and make cash. And by doubling the size of government, that money has to come from somewhere. So you just keep taxing the 73-year-old more and more and more. That's not the answer, folks. So, positive-wise, can the government do this? And the big question is, do they want to have the prices go up? I say, if their election platform is to make homes more affordable, there's a chance they actually are not going to make any of these changes to force overall prices down another 15% over the year. By the way, one big thing looming in the forest in the future is our NAFTA free trade agreement with the States, which is one of the best in the world. It's free trade across the border. That comes up for renegotiation pretty quick, and it's not going to be pretty. So that's a big looming, 85% of our trade is going to have to go through a new trade agreement. And right now, nobody's talking. Not good. Okay, so in summary, you've seen the market drop. We're down 30% from the peak. You see the forecasts are to go up another 5% on the positive. If we can achieve 2 or 3 or 4 of these changes to make the consumer actually go out there and buy and be able to afford to get a mortgage. And on the negative side, if the government cannot address these issues, then we're going to see more job loss, more people moving to the States, more capital leaving Canada, and less opportunity, less people being able to qualify for a mortgage. So that will push the demand down dramatically and cause prices to fall even further. Hey, listen, love your input. If you're seeing this in the Vancouver Market Reports social media, give us a like, join us, put on notify. And if you're seeing us on the real estate marketing trailblazers.com program, helping all sellers and all realtors learn more skills to provide the top 1,000 secrets to be in your top in the industry and to win. Join us and stay in touch. Appreciate your comments. I love debating, so love to hear your opinion. Bye-bye for now. Bill Coughlin signing off. Welcome to the Real Estate Marketing Trailblazers. This is where we get to share with you the thousands of secrets of the top producers. So listen up. This is your $1 million lesson. Think outside the box.